We're looking at China today, much like we were looking at Japan in 1989. As it turns out, we were about to experience a bit of a bust. And I wouldn't be surprised if the same thing happened here because of China.
Over the last 2 decades, China has developed into a global economic superpower. It has outperformed every other country on the planet in terms of economic growth. But what if we told you that China's entire expansion was a hoax? Cathie Wood, the CEO of ARK Invest, thinks this. After 20 years of growth, China's real estate market is currently valued at more than $50 trillion, more than twice as much as the United States and nearly 4 times as much as China's entire GDP. How did this contribute to the downfall of the economy? Hello and welcome back to Wall Street Winners. In today's video, we'll discuss everything you need to know about the fall of China's economic growth and Cathie Wood's opinion on this. China's economy has developed significantly over the last 2 decades, but real estate has accounted for a significant amount of that growth. Developers have taken out loans to expand their real estate holdings into hundreds of cities. People began buying residences solely for the goal of capital appreciation. Because housing prices continued to rise year after year, the majority of Chinese citizens were unable to purchase a conventional house or apartment in cities such as Beijing or Shanghai and began to relocate 10 to 15 kilometers away. Property developers anticipated that this growth would continue, so they built houses further and further out ahead of schedule, but none of them are occupied yet. According to Loomis Sales, a wealth management organization, real estate accounts for 70% of China's total wealth. It's not uncommon in China for residents to put money aside for decades to purchase a single property. Property prices near cities are so expensive in comparison to income that even after years of savings, individuals will be forced to rely on mortgages to keep their homes. This is exacerbated by the fact that rising property prices create a fear of missing out, leading people to take out risky loans. We saw similar signals in the United States during the 2008 recession, and we're seeing them now in China. China's real estate boom is already slowing down. Similar to previous financial crises, greed took center stage and developers were soon saddled with far too much debt to manage. Evergrande, the pinnacle of Chinese property development, was one of these developers. Evergrande increased its real estate holdings to over 565 million square meters of developing land by issuing corporate bonds to overseas investors. They were only able to do so because they borrowed more than $300 billion. But later, Evergrande was recently classified as in default by credit agencies after the company failed to repay the $260 million interest payment. There is more evidence to support this theory. Shimao, a Chinese real estate developer, recently missed a $101 million interest payment. Another developer, Oceanwide Holdings, went bankrupt after defaulting on a $175 million loan. In the fourth quarter of 2021, a total of 484 enterprises were behind on at least 3 commercial payments, according to a recent exchange. That's a huge sum. In December 2021, contracted sales for the top 100 real estate development firms were down 35%. According to Cathie Wood, this is the first year in over 20 years that development companies have seen a drop in revenue. Even the Federal Reserve has taken notice of China's housing bubble, believing that a recession in China's real estate market will eventually harm the US economy. Stresses in China's real estate sector, according to the Fed, could strain the financial system with potential spillovers to the United States. The organization mentioned China's government and local debt as a major issue to back up this allegation. Many analysts believe China's rapid GDP growth is an indication of economic prosperity. However, not only in real estate but throughout China's economy, a massive debt bubble fueled most of that expansion. Over the last 2 decades, China's household debt has climbed significantly concerning both income and GDP. Household debt is rising at a faster rate than GDP. True, China's GDP has been increasing at a breakneck pace, but the country's debt load has been growing even faster. Such overstretching is going to have undesirable repercussions. Another issue raised by the Fed is overvalued real estate and how the Chinese Communist Party's crackdowns could bring those values crashing down. That statement was made in response to Chinese government's 3 red lines policy in the real property sector. The 3 red lines represented borrowing limits for the real estate developers, a liability to asset ratio of less than 70%, a net debt to equity ratio of less than 100%, and cash to short-term debt ratio of 1 other 3 conditions. Companies that meet these requirements will be able to increase their debt by 5% per year for each red line met. Cathie Wood compared the CCP's activities to playing with fire because their new policies have the potential to suffocate the entire property market. It would be tough to pull the developers back to the ground floor now since they have become overextended. But at least one red line has been crossed by 2/3 of China's top 30 developers. The issue with these 3 lines is that property developers cannot simply reduce their liabilities with a wave of their hand. The only way to stay within the lines is to sell properties, which is exactly what many developers are doing now. Evergrande and Kaiser Group Holdings are frantically trying to sell their properties. Evergrande is looking to sell its Hong Kong headquarters, the Evergrande Tower. That property, however, has not yet been sold. Kaiser Group Holdings has put 18 of its projects on the market, totaling 4.7 million square feet. Kaiser, like Evergrande, has yet to sell any of these properties. The issue with all of these properties going on the market is that there aren't any buyers. This is because all the real estate developers are attempting to meet the same 3 red line requirements. If there are no buyers for all the properties on the market, Evergrande and Kaiser will have no choice but to lower their prices, and if those prices are continually dropped, the market will collapse. According to the Federal Reserve, China's approaching downturn will affect individuals all across the world, not only Chinese nationals. The Fed stated that if the Chinese real estate market collapsed, the entire global economy would be affected. China manufactures almost every good you can think of. China produced about 28% of global industrial output in 2019. You might think China is too big to fail, but we've seen this type of economic slump before. Even though the catastrophe occurred decades ago, Japan's 1989 real estate crash is eerily comparable to the current situation in China. Because equity prices did not recover for decades, this crash is known as the lost decades. China, according to Cathie Wood, is in a very similar scenario. Their real estate prices have risen to new highs, fueled by the country's mounting debt issue. With that, the coming crash has massive deflationary ramifications. The country's faltering economy, in particular, will send commodities plunging to new lows. A looming crash might have far-reaching consequences as well. Cathie Wood is perplexed because commodities haven't crashed significantly yet. Consumer confidence is typically weakened by lower commodity prices, but consumer confidence remains high, which could be misled by food prices. Accordingly, property prices have started to plummet. In November, Chinese property sales dropped by over 16% year-over-year, while new home prices dropped by 0.3% month-over-month. A 0.3% drop month-over-month may not seem like much, but when annualized, it equals a 3.6% drop. Housing prices in China have dropped to levels not seen since the country's economic slowdown in 2015. Cathie stated in ARK Invest's quarterly report that she believes China's economy will slow significantly in the next 3 to 6 months. If the market's predictions are correct, the market will focus more on the risk of a US recession, the serious slowdown in China and emerging market economies, and the possibility of a surprise drop in inflation over the next 3 to 6 months, she said. She also highlighted that some commodity prices had already begun to trend downward. Iron prices have dropped 35%, possibly as a result of China's real estate woes, while the Baltic Freight to Dry Index has dropped more than 40%. DRAM prices have dropped 25% and US lumber prices have dropped 33%. Even the WTI oil price, which has been a notable outlier until recently, has dropped by 12%. The Chinese Communist Party has acknowledged that China's economy is weakening and has taken steps to prevent a crash. China's central bank recently announced interest rate reductions to help the economy. This is in direct opposition to the Federal Reserve Chairman Jerome Powell, who wants to raise interest rates as soon as possible. China's property market is in serious trouble and it's only going to get worse. Due to credit tightening and restrictive policies, S&P expects a 10% drop in nationwide residential sales in 2022. This decline will have an impact on everyone on the planet, all around the globe. What are your thoughts on this? Do you think China might actually take the hit, or is it possible for them to overcome this crisis in the near future? Start commenting on your answers below. Hope you liked our video. Please subscribe to our channel and remember to hit the like button, turn on the notification bell so that you'll be notified whenever we release a new video, and share the video as far as possible because the more you know, the more you grow. Goodbye.